I need to tell you something that I haven't said publicly before. In my 7 decades of investing, I've learned to recognize a specific constellation of warning signs, and I'm seeing them flash again. Each time I've witnessed this particular signal, it has preceded a significant market decline, a wealth-destroying crash that separated the prepared from the devastated. The last time I saw a picture like this, it ended badly for millions of investors who ignored it, and very well for those of us who recognized it and positioned ourselves accordingly. What I saw last month wasn't just one signal, it was a constellation of warning signs that taken together paint a picture I have seen before. Let me take you back to 1969, because that's when I first learned to recognize this particular pattern. I was running my investment partnership at the time, and we had been enormously successful. My partners were happy, money was pouring in, and the market was hitting new highs almost every week. Everyone thought the good times would never end, but I saw something that troubled me. It wasn't in the stock prices themselves, nor in the earnings reports or the economic data. It was in the behavior of the people around me, smart, educated people who should have known better. They had stopped analyzing investments and started speculating on price movements. They weren't buying businesses anymore. They were buying lottery tickets, convinced they could not lose. I remember one conversation in particular. A friend of mine, a successful businessman, told me he had put his entire savings into a technology company. I asked him about the company's earnings, its competitive position, its management team. He looked at me like I was speaking a foreign language. Who cares about earnings? He said, the stock has doubled in 6 months. That's all that matters. That conversation haunted me because I knew what it meant when intelligent people abandon fundamental analysis in favor of momentum chasing, when they stop caring about value and start caring only about price. The end is near. It may not come tomorrow or next month, but it is coming. And it's coming faster than anyone expects. I closed my partnership that year, returning all the money to my investors. They thought I was crazy. Some were angry, accusing me of abandoning them right when the party was getting started. But I knew what I knew. Enough from 1969 to 1974, the market fell nearly 50%. Those same investors who criticized me for being too conservative watched their portfolios collapse by half. Many of them never recovered. The signal I saw back then is the same signal I'm seeing now. And I want to explain it to you in detail so you can recognize it yourself and protect yourself from what I believe is coming. The signal has 3 components. The first component is what I call the confidence gap, the divergence between investor confidence and economic reality. When investor confidence is high, but economic fundamentals are deteriorating, that gap becomes dangerous. The wider the gap, the more violent the eventual correction. Right now, that gap is as wide as I have ever seen it. Consumer sentiment surveys show extraordinary optimism. Retail investors are pouring money into the market at record rates. The amount of margin debt, money borrowed to buy stocks, is at all-time highs. People aren't just confident, they're aggressive, leveraged, and convinced that the only direction is up. But look at the underlying economy. Look at what is actually happening beneath the surface. Corporate earnings growth is slowing dramatically. Many companies are masking their true performance through financial engineering, through stock buybacks, through aggressive accounting. The real economy, the economy where people buy things and companies make things, is not as strong as the stock prices suggest. I've been tracking a metric I call operating earnings quality for 60 years. It means how much of reported earnings come from actual business operations versus financial maneuvering. In healthy markets, operating earnings quality is high. Companies make money by selling products and services. In late-stage bull markets, operating earnings quality deteriorates. Companies make their numbers through cost cutting, through one-time gains, through accounting adjustments. Right now, operating earnings quality is at its lowest level since 2007. That should concern you. The second component of the signal is what I call the amateur hour phenomenon. This is when inexperienced investors start dominating market activity, when people who have never lived through a bear market start giving investment advice, when trading becomes entertainment rather than a serious business endeavor. I see this everywhere I look right now. Social media is filled with people bragging about their trading profits. Young investors are using options to place leveraged bets on individual stocks. Day trading has become a hobby. Speculating on meme stocks has become a game. And the common refrain I hear over and over is, "This will never crash. We figured out the market. The old rules don't apply anymore." I remember hearing certain words back in 1999, that the internet had changed everything, that traditional valuation metrics were obsolete, and that companies didn't need profits because they had growth. I heard them from very smart people with impressive credentials. And every single one of them lost enormous sums of money when the bubble burst in 2000. The amateur hour phenomenon is particularly dangerous. Amateur investors tend to make the same mistakes at the same time. They pile into the same trades, use the same strategies, and follow the same influencers. When the market turns, they all run for the exits at once. That's what creates crashes. Not gradual declines, but crashes, when everyone is positioned the same way and everyone panics at the same time. There are no buyers, only sellers, and prices collapse. The third component of the signal, and this is the one that concerns me most, is what I call institutional capitulation. This is when professional investors, the people who are paid to be skeptical, abandon their skepticism and join the crowd. When the last bears throw in the towel and even the most conservative money managers start chasing performance because they can't afford to underperform any longer. I've been watching this happen over the past 18 months. Fund managers who built their careers on fundamental analysis have started momentum trading. Pension funds that are supposed to protect retirement savings have loaded up on speculative assets. Insurance companies that need predictable returns have reached for yield and increasingly risky investments. The institutions that are supposed to provide stability and rationality to markets have become part of the speculation. When I see all three components of this signal present at the same time, a wide confidence gap, amateur hour in full swing, and institutional capitulation, I know we are in the late stages of a market cycle. I know that the probabilities have shifted dramatically toward a significant decline. I know that caution is warranted. Now, let me tell you specifically what I observed last month that triggered this warning. It wasn't one thing, but a series of things that, when taken together, formed a pattern I couldn't ignore. The first thing I noticed was the behavior at a charity dinner I attended. This was a room full of successful business people, entrepreneurs, executives, professionals who have built real wealth over long careers. And the conversation was dominated by stock trading, not investing. People were comparing their returns from the past year like teenagers comparing video game scores. They were discussing which stocks they had flipped for quick profits. They were bragging about their options trades. One gentleman, a man I have known for 30 years, a conservative investor who built his wealth slowly and carefully, told me he had put 50% of his portfolio into technology stocks in the past 6 months because he couldn't stand watching others make money while he sat on the sidelines. This is a man who lived through the dot-com crash, a man who should know better. but the fear of missing out had overwhelmed his good judgment. The second thing I noticed was in the credit markets. I track credit spreads very carefully because they tell you what sophisticated lenders think about risk. When credit spreads are tight, it means lenders are confident. When they are wide, it means lenders are worried. For the past year, credit spreads have been extraordinarily tight. Lenders have been throwing money at borrowers with minimal compensation for risk. Companies with questionable finances have been able to borrow at rates not much higher than the government. That is not normal. That is euphoria. But in the past few weeks, I have seen something concerning. Credit spreads have started to widen. Not dramatically, not enough to make headlines, but enough for me to notice. The sophisticated money, the money that lives and dies by credit analysis, is starting to get nervous. They are starting to demand more compensation for risk. That is often the first crack in the foundation. The stock market is usually the last to know. The third thing I noticed was in the behavior of corporate insiders. These are the executives and directors who know their companies better than anyone. When insiders are buying their own stock, it is usually a good sign. When insiders are selling, it can mean many things. They might need money for personal reasons. They might be diversifying their holdings. But when insider selling accelerates across multiple companies and multiple industries simultaneously, that is a warning sign. In the past 3 months, insider selling has reached levels I haven't seen since 2007. Executives across the technology sector, the financial sector, the industrial sector are all reducing their holdings. Not one or two executives, hundreds of them. They know something. They may not know exactly what is coming or when, but they know that current valuations are not sustainable and they are taking money off the table while they can. The fourth thing I noticed, and this is perhaps the most troubling, is the proliferation of investment products that exist primarily to extract fees from retail investors. I'm talking about leveraged ETFs that decay in value over time. I'm talking about complex structured products that promise high returns with hidden risks. I'm talking about cryptocurrency derivatives that nobody truly understands. I'm talking about private credit funds marketed to individuals who have no bus. Wall Street has a way of creating investment products late in bull markets. It's driven by high demand, by investors hungry for returns. People stop questioning risk and only focus on reward. I've noticed that the complexity of these products isn't accidental. It's designed to hide the risks, making them appear safer than they are. And when the market eventually turns, those who bought them will face a harsh reality. I'm sharing this not to cause panic, but because I believe awareness creates opportunity. Investors who understand where we are in the cycle can protect their capital and be ready to act when opportunities arise. Let me tell you what I'm doing with my own money. At Berkshire Hathaway, we're holding over $300 billion in cash and short-term treasury bills, our largest cash position ever. Some analysts criticize this, saying we're missing out on potential gains. They might be right in the short term if the market continues to climb, but I'm not focused on maximizing short-term returns. My priority is protecting capital and positioning ourselves for long-term opportunities. The key to protecting capital is patience, avoiding overpayment for assets, and having cash available when bargains appear. And believe me, bargains always appear. I remember in 2008 when the financial system was collapsing and credit markets were frozen, we had cash. We invested $5 billion in Goldman Sachs and $3 billion in General Electric on extraordinarily favorable terms. We made billions because we had the resources and the courage to act when others were paralyzed by fear. That's the payoff for patience. Well, that's why I hold cash even when it seems foolish. Now, let me offer some practical guidance. First, examine your portfolio honestly. How much risk are you taking? Do you own speculative assets that you bought simply because they were going up without truly understanding the underlying business? Do you have concentrated positions in popular stocks with valuations that require decades of flawless execution to justify? Be honest with yourself now, before the crash, not after. Second, consider your time horizon. If you're young and investing for retirement decades away, market volatility is your friend. Declines offer opportunities to buy more shares at lower prices. The longer your time horizon, the less you should worry about market timing. Just keep investing consistently regardless of market fluctuations. But if you're older and need your money within the next 5 or 10 years, be more cautious. Allocate more to stable income producing assets. You can't afford to see your portfolio cut in half right before you need the money. Third, avoid leverage. This is crucial advice. Leverage magnifies both gains and losses. When the market rises, it makes you feel like a genius. When it falls, it can destroy you. I've seen more investors ruined by leverage than by bad stock picks. Smart, educated people who understood the risks intellectually but underestimated them emotionally. When you borrow to invest, you lose control of your destiny. Your lender takes over, and they won't care about your long-term plans when they demand repayment at the worst possible moment. Fourth, focus on quality in bear markets. Quality outperforms. Seek companies with strong balance sheets, consistent cash flows, and durable competitive advantages. These businesses survive downturns and emerge stronger. Avoid companies with weak finances, heavy debt, or unproven business models. When the tide goes out, you see who's been swimming. Make your knot holding stocks that will be exposed when conditions deteriorate. Fifth, have a plan. Know what you'll do if the market drops 10%, 20%, 30%, 40%. Write it down. Because when the market is crashing, you won't be thinking clearly. You'll be emotional, tempted to panic, and sell at the bottom. A written plan helps you stay disciplined and act rationally when everyone around you is acting irrationally. Let me share a story about the importance of having a plan. In 2008, a successful investor friend of mine who had built significant wealth called me. The market had just fallen 20% in weeks. He was terrified and wanted to sell everything. He couldn't sleep watching his net worth evaporate and feeling helpless. I asked him what his investment plan called for in this scenario. He admitted he didn't have a written plan. He had always just done what felt right, and right now getting out felt right. I told him his feelings were understandable, but acting on them would be a mistake. The time to sell was before the crash, not after. Selling now would lock in his losses and guarantee he'd miss the recovery. He didn't listen. He sold everything going to cash almost at the exact bottom of the market. And then he watched I remember a conversation I had with a man who sold all his stocks in March 2020. He was convinced the world was ending. He sat on the sidelines watching as the stocks recovered. He watched as the market eventually hit new highs. His former portfolio would have more than tripled in value. He was too embarrassed to buy back in at higher prices. The last time I spoke with him, he was still mostly in cash, still waiting for the perfect moment to reinvest. That moment never comes, you see. The lesson isn't that you should never sell. Sometimes selling is the right decision. No. The lesson is that your decisions should be based on analysis and planning, not emotion and panic. The worst decisions are always made in moments of maximum fear or maximum greed. The best decisions are made calmly, rationally, with a long-term perspective. I know some of you are thinking, I've been warning about market risks for years. I was cautious in 2015 and 2018 and 2020, and each time the market eventually went higher. Am I just a permanent pessimist? Am I crying wolf? It's a fair question, and I want to answer it honestly. Yes, I have been cautious for several years. Yes, the market has continued to rise. And yes, my caution has meant that I have missed some gains. But here's what I would say in my defense. The fact that the market hasn't crashed yet doesn't mean the risks aren't real. It means we've been lucky. It means the timing hasn't yet arrived. Market crashes are like earthquakes. Just because the big one hasn't hit yet doesn't mean it won't hit. It means Prez is building along the fault lines, and when the release comes, it will be violent. Moreover, my caution hasn't been costly. My firm has continued to grow its intrinsic value. We've continued to earn returns on our operating businesses. We've used our cash position strategically when opportunities appeared. We may have underperformed in the short term, but we've protected ourselves from catastrophic loss. And in investing, avoiding catastrophic loss is more important than maximizing short-term gain, because mathematics is asymmetric. If you lose 50%, you need to gain 100% just to get back to where you started. The best way to build wealth is to avoid large losses. Everything else is secondary. Let me talk about what this warning signal suggests about specific sectors of the market, because not all stocks will be affected equally. Some areas look particularly vulnerable. Others may actually offer safety. Technology stocks concern me the most. The largest technology companies have become a massive portion of the market indices. Their valuations assume continued growth at rates that become increasingly difficult to maintain as companies get larger. Many of them are spending enormous sums on artificial intelligence with no clear path to returns. The enthusiasm around AI reminds me of the enthusiasm around the internet in 1999. Yes, the internet changed the world. Yes, many companies made fortunes from it, but many more companies lost fortunes betting on it too early or too aggressively. And the timing of returns was much longer than anyone expected. I think AI will be transformative. I think it will create enormous value over the next few decades. But I also think that the current valuations of AI-related stocks assume a level of success and a speed of adoption that may not materialize. When expectations are this high, disappointment becomes almost inevitable. Not because the technology fails, but because reality rarely matches the most optimistic projections. Commercial real estate continues to be a disaster in slow motion. Office buildings in particular are facing structural decline. The shift to remote and hybrid work is permanent. Companies are not going back to the old model. They are reducing their office footprints. They are letting leases expire, and the buildings that were financed with debt based on old occupancy assumptions are underwater. This is going to create problems for regional banks. It's going to create problems for insurance companies. It's going to ripple through the financial system in ways that are not yet fully visible. Consumer discretionary stocks worry me because the consumer is running out of gas. The excess savings from the pandemic are gone. Credit card debt is at record highs. Delinquencies are rising. The consumer has been remarkably resilient, but that resilience is fading. When the consumer finally pulls back, the companies that depend on discretionary spending will feel it immediately. Where do I see safety? Boring businesses with pricing power. Companies that sell things people need, not things they want. Utilities, consumer staples, healthcare, insurance. These are not exciting investments. They won't double overnight, but they will survive whatever comes. They will continue paying dividends. they will be worth more in 10 years, regardless of what happens in the next 2. I also see opportunity in energy, not because I can predict oil prices. Nobody can predict oil prices, but because energy companies have become disciplined about capital allocation. They've paid down debt. They've increased dividends. They've stopped chasing growth at any cost. And they trade at valuations that assume very little good news. When expectations are low, even modest positive surprises can create significant returns. Let me leave you with this. The signal I've described, the confidence gap, the amateur hour, the institutional capitulation, these things don't tell you exactly when the market will top. They tell you that conditions are dangerous, that risk is elevated, that the margin of safety is narrowed to a dangerous degree. You can still make money in this environment, but you're taking more risk for each dollar of return, and the potential downside is growing larger by the day. I've been investing for over 70 years. I've seen 14 major crashes. I've watched trillions of dollars of wealth evaporate. And I've learned that the time to be cautious is when everyone else is greedy. It's not when everyone is cautious that danger lurks. It's when no one is, when the world seems safest, when everyone is making money and the future seems bright. That's precisely when danger is greatest, because that's when complacency peaks, vigilance disappears, and the seeds of the next crisis are planted. And a signal I've been watching tells me we're nearing that moment, a moment of maximum complacency, a moment when everyone has forgotten that markets can in fact go down, when the lessons of the past are dismissed as irrelevant to the new paradigm. I've seen this before in my years as a historian. I know how it ends, and I'm sharing this now while there's still time to prepare, not to panic, not to sell everything and hide, but to examine your portfolio, reduce risk, raise quality, hold some cash, and have a plan. Because when this turns, and it will, you'll want to be ready to be the person with resources and discipline, not the one scrambling to survive. I want to delve deeper into something critically important, the psychology of market tops. Understanding this will help you recognize these moments long after I am gone. At market tops, there's always a narrative, a story everyone believes, a reason why this time is different. In 1929, it was that America had entered a new era of permanent prosperity. In 1973, the Nifty 50 stocks were considered one-decision stocks you could buy and hold forever. In 1999, the internet had supposedly changed the rules of business, and traditional valuation no longer applied. In 2007, real estate never declined nationally, and financial engineering had eliminated risk. Today, the narrative revolves around artificial intelligence. AI will transform every industry, the story goes, and the companies building AI will become the most valuable in human history. Anyone who doesn't invest heavily will be left behind. And here's the thing, that narrative is probably correct. AI probably will transform industries, and some AI companies probably will become extraordinarily valuable. But that doesn't mean current prices are justified, or that you should pay any price to participate, or that there's no risk. The internet really did change the world, but that didn't prevent internet stocks from falling 90% when expectations outpaced reality. The danger of a compelling narrative is that it makes you feel smart for believing it. It makes skepticism seem foolish. Anyone who questions it is dismissed as a dinosaur who doesn't understand the new paradigm, and those who believe most strongly are rewarded with profits, at least temporarily, which reinforces their belief and silences their doubts. Over decades, I've trained myself to be suspicious of these compelling narratives, not to reject them outright, but to examine them critically, to ask what's already priced in, to consider what could go wrong, to remember that even true narratives can create bubbles when they become too widely believed.